The mother of all credit crises is coming to China, with over $250 billion owed by insolvent banks and state-owned enterprises, not to mention off-the-book liabilities and provincial governments, wealth management products, and developers of white elephant infrastructure projects. Then there's the emerging markets credit crisis, with Turkey and Argentina leading a parade of potentially bankrupt borrowers vulnerable to hot money capital outflows and a slowdown of growth in developing economies. And close on their heels is the U.S. student loan debacle, with over $1.5 trillion in outstanding debts and default rates approaching 20%. Now we're facing a devastating wave of junk bond defaults. The next financial collapse, already on our radar screen, will quite possibly come from junk bonds. And this information comes from James Rickards via the Daily Reckoning. Can you imagine that? The Daily Reckoning. This information comes out daily. So his subscribers are reading this information day after day after day after day. And I'm sure you've noticed many YouTube channels that march out all this information that the collapse is here, the collapse is near, the collapse is occurring. Well, I don't want to be a doom and gloom kind of guy. I'll march out this information for you. It is important to recognize this information, but what I'm going to do is something that most don't, is we'll look at the timing. So no one knows when all of this will come, and neither do I necessarily. However, we can explore when the probabilities increase. So first today, we're going to go over the information, and then we'll look at the potential timing of the next crisis. Let's take a look. According to Jim Rickards, since the great financial crisis, extremely low interest rates allowed the total number of highly speculative corporate bonds or junk bonds to rise 58% to a record high. Many businesses became highly leveraged as a result. There is currently a total of about $3.7 trillion of junk bonds outstanding. And when the next downturn comes, many corporations will be unable to service their debt. Defaults will spread throughout the system, and the damage will be enormous. And according to Moody's senior credit officer, Maria Rosa Verde, this extended period of benign credit conditions has helped many weak, highly leveraged companies to avoid default. A number of very weak issuers are living on borrowed time while benign conditions last. These companies are poised to default when credit conditions eventually become more difficult. The record number of highly leveraged companies has set the stage for a particularly large wave of defaults when the next period of broad economic stress eventually arrives. Each credit and liquidity crisis starts out differently, but ends up the same. Each crisis begins with distress in a particular overborrowed sector, but then spreads from sector to sector until the whole world is screaming, "I want my money back." The problem is that regulators are like generals fighting the last war. In 2008, the global financial crisis started in the U.S. mortgage market, but spread quickly to the overleveraged banking sector. Since then, mortgage lending standards have been tightened considerably, and bank capital requirements have been raised steeply. Although banks and mortgage lenders may be safe today, the system is not. Meanwhile, the Fed is raising interest rates. It's undertaking quantitative easing in reverse by reducing its balance sheet and contracting the base money supply, and this is called quantitative tightening. Credit conditions are already starting to affect the real economy. New cracks are appearing in emerging markets, and student loan losses are skyrocketing. That stands in the way of household formation and geographic mobility for recent graduates. Losses are also soaring on subprime auto loans, which has put a lid on new car sales. As these losses ripple through the economy, mortgage and credit cards will likely be next. It doesn't matter where the crisis begins. Once the tsunami hits, no one will be spared. The stock market is going to correct in the face of rising credit losses and tightening credit conditions. No one knows exactly when it'll happen, but the time to prepare is now. Once the market corrects, it'll be too late to act. And although no one knows exactly when it'll happen, at least we can take a look at the potential increases in that probability. So let's take a look. So this chart here of the S&P 500, or the spiders, the ETF, is one of my top indicators of when potentially we may have a problem in the stock market. This is a 20-year monthly chart, and we've talked about this before. This is the previous high back in late 2017, early 2018. We are approaching that level here. We have a little further to go. But once we get to that point here, that to me is the maximum probability, at least for now, of a problem or potential problem in the stock market. Once we reach that level there, we're going to hit, in my mind, what is looking like a massive double top. Have you heard that from anybody else? No, not likely. So keep your eyes open. That, in my mind, is going to be an increase in the probability of a stock market correction, a massive double top, and that's going to take a little longer, several weeks, if not a little longer. So we watch this on a weekly basis, and I'll keep you up to date. Let's go to another indicator. And this chart here, which is the 10-year Treasury note, looking at the symbol is TNX. We're looking at a monthly basis going back to, say, 1995. And this is one of my other favorite indicators of a stock market or the potential for a stock market correction. And as you can see here, we recently went above 3.0 on the yield, coming all the way up here from 1.5 or below 1.5 in the 10-year yield. The only other time that we had a double in the yield rate was back here when we are also below the 1.5 and came up to about 3.0. That's when we had a correction in the stock market. So we've doubled the interest rate yield from this point here about a year and a half ago to just above 3%. We are approaching, we're heading back up again to that 3% mark. Possibly we're going to go above that. So there's an imaginary line that reaches from this point here all the way up through here, the tops of the previous highs in the 10-year yield, going all the way back there, if not further. And each time we reached that imaginary line, we had a stock market correction. So in my mind, the probabilities of a stock market correction are increasing the closer to that 3% yield. And that's going to happen here probably at least a few weeks, if not a little longer. But then again, I'm watching this on a daily basis. So this is nothing new to my viewers. You've heard this before. So keep watching, subscribe to this channel, because I will keep you up to date. So for today, that's ChewDog Charts. Thank you.